Hello and welcome to today's Tax in 10 topic, personal finance during COVID-19. May I start by saying that I hope that you and your family are all keeping safe and well, and my thoughts are with you if your family has been touched by this terrible virus. We know we live in unprecedented times. There is a health pandemic, faltering economies, part-time working, furloughing, massive government intervention and national debt, and market volatility. COVID-19 has presented both financial and relationship challenges, but for many it has also provided something valuable: time. Time to reflect, time to reassess, time to plan. The purpose of this brief presentation is to provide some food for thought when you are thinking about your personal finances. James Cooper Creston is not authorised or regulated to give investment or pensions advice, but we are well used to and experienced in working closely with financial advisors and wealth managers to deliver our clients the best result. Here are the areas I wish to comment on. Income tax. As we move through the remainder of the tax year, many married couples and civil partners will find that the balance of income between them has changed, so that for this tax year, one will suffer a greater reduction in income than the other. Amongst other things, this can result in a loss of personal tax allowances and unused rate bands. The existing asset base and income should therefore be reviewed. Given that transfers of assets between spouses and civil partners are tax-free, it is possible to rearrange asset ownership so that income and indeed capital gains can be split most tax efficiently. If you are running a business and are anticipating losses from your trade, it might be possible to accelerate recognition of those losses by changing the accounting date of your business and thus bring forward tax relief for those losses. Losses can also be carried back 1 year and result in a tax refund. In addition, it will be more important than ever for your business to closely scrutinise any outstanding debts so that bad debt relief can be maximised, both for income tax and VAT. Tax management. Self-assessment payments on account due on the 31st of January 2020 can be deferred until January 2021, whether or not you are self-employed. This will be automatic and no deferral application is required. No penalties or interest-related payment will be charged during the deferral period. If you take up this deferral option and normally pay your tax by direct debit, you need to cancel this direct debit well in advance of the 31st of July payment date. As far as the 2020 tax return is concerned, the filing deadline remains unchanged. But if you are concerned about short-term cash flow problems, you may benefit from submitting your 2020 tax return sooner rather than later. This will help you plan for the tax payment due in January 2021 and enable you to benefit sooner if you are due a refund. Your planning should also include looking at your anticipated taxable income for the current tax year ending 5th April 2021. So that the payment on account, also due in 2021 in January, can be reduced where possible. Capital gains tax, or CGT. It has long been the case that individuals have sold investments to realise profits within their tax-free annual allowance. Often their spouse or civil partner has bought the same investment subsequently into their portfolio, the purpose being to wipe out the accumulated gain to date while still effectively retaining the investment. As a twist to this, it might be beneficial to sell investments, then to reacquire them through your own 2020-21 ISA. Any growth from the economic recovery will then be capital gains tax-free. When it comes to capital losses, these can be offset against gains in the same tax year, and if any remain unused, the excess can be carried forward against gains in a subsequent year. Inheritance tax, or IHT. IHT is perhaps the most loathed tax on the statute books. If, as seems likely, tax will need to go up to repair the nation's finances, IHT is unlikely to be immune. So now is a good time to plan to stay ahead of any capital tax reforms that might be pushed through in an emergency budget. Recent reports have mooted major changes, such as the abolition of 3 key tax relievers: business and agricultural property reliefs, the tax-free capital gains tax uplift on death, and the 7-year rule for potentially exempt transfers. Lifetime gifts become IHT exempt once the donor has survived the gift by 7 years, thus reducing the IHT on death. Even if that period is not satisfied, there can still be a benefit in making the gift because the IHT will be based on the value of the asset at the date of the gift, which might be lower than at the date of death. This can also protect or enhance the resident's nil rate band. Now might therefore be a good time to make gifts to start the 7 years ticking, to fix the IHT value at today's date, and to reduce the impact of any future tightening of the tax. It must be remembered that CGT is also relevant to lifetime gifts, because any gain in value when the asset was acquired is subject to CGT. That charge will be lower if values have reduced. If there is a taxable gain, the use of a trust can also mitigate the CGT charge and may also be suitable for other reasons such as asset protection. Whilst there are restrictions on obtaining formal property valuations for the purpose of this planning exercise, it might be possible to obtain a sufficiently reliable estimate remotely to enable the planning to be carried out. It should also be noted that it can be difficult to take out life assurance policies at the moment to cover potential IHT charges because doctors are limited in what medical assessments they are able to undertake. All that said, even if action cannot be taken now, planning can be thought through and preliminary advice taken so that action can be taken once restrictions are lifted. This time might prove critical if any succession planning is to be executed ahead of any emergency post-COVID-19 budget. Finally, it is important that full stock is taken of your financial situation to ensure affordability of gifts, and to remember that where an asset is given away, you cannot retain any benefit in it other than for payment at a market rate. General financial planning. In these difficult times, it is important to assess the health of your wealth and carry out, as it were, a financial MOT. As a firm, we cannot provide investment advice, but by working with you and your financial advisor or wealth manager, we can secure the best outcome for you. Here are some questions, therefore, you might like to think about as part of your review process. We will be pleased to discuss them to help you work through your processes if required. Are my goals and objectives for retirement, capital growth and income still realistic? Is the balance of my portfolio right to take advantage of the recovery? Do my retirement plans need to be reassessed in terms of timing and/or the level of my retirement income? Do I need to adjust the level of my pension drawdown and/or my expenditure to prevent me outliving my capital? Is now a good time to look at testing the value of my pension savings against the lifetime allowance to mitigate future charges? And finally, how is my portfolio positioned if there is an increase in tax rates? And might some form of tax wrapper be appropriate in managing those tax liabilities? I hope these questions are helpful to you. It's important to make the point that such reviews should be supported by a personal cash flow modelling exercise to assess the long-term impact of any decisions, especially for retirement planning purposes. Wills. Now is also a good time to look at reviewing and making wills. To be validly made, a will must be witnessed. This requires the signature of the person making the will to be made in the presence of 2 or more witnesses present at the time. The current view is that in England and Wales, a will is not valid if it has been witnessed, say, via Skype or video conferencing. Nevertheless, it is still possible for a will to be witnessed at a physical distance, so long as there is a direct line of sight. There is therefore no need to be put off from doing this very important job. You just need to discuss arrangements with your solicitor. Well, that is all I have time to cover today. I hope that you found this short presentation interesting and useful. We welcome your comments, so if you do have any feedback, please do get in touch with us. We are also here to help, so if you would like more information, please feel free to contact us. Thank you for listening and keep safe. Goodbye.